Recently, lot of news is floating around everywhere regarding the Adani Enterprises FPO. So, are you also curious to know about FPOs? If so, then you have come to the right place. In today's video, we are going to explore the exciting world of IPOs and FPOs using a simple example. So, let's start. Let's say Mr. A is really good at making tea and believes that he can make good money by selling it. So, he uses his 10 lakhs of savings and opens a tea stall, and within 6 months, he starts earning good money. Seeing the success of his first tea stall, Mr. A thinks of growing his business by adding another tea stall. But this will require an additional investment of rupees 10 lakhs. Now, at this point, he has three options. He could invest the funds generated by his first tea stall to finance the another tea stall with his own money, and that's called bootstrapping. Or he could go to the bank and take a loan to finance the second tea stall, and that's called leveraging. Or he could raise the funds from an angel investor. In this case, Mr. A gets the financing of rupees 8 lakhs against the 5% stake from an angel investor who believes his idea and decides to invest in him. Mr. A borrows the balance amount of rupees 2 lakhs from the bank. Using these funds, he opens the second tea stall. Mr. A's company takes off and becomes a hit in the state over the next 2 years. Seeing the growth, this time Mr. A decides to expand his business further by capturing the neighboring states as well. But there is one problem. This will require a lot of money, and the cash generated by his business is nowhere close to what is required. So, since his tea has become very popular among the public and he is quite confident about his future growth, this time he decides to go for a public offer by selling his 55% of the stake. So, his company gets listed on the stock exchange and shares of A Limited starts trading at rupees 10. With the money raised through IPO, Mr. A builds up few more tea stalls in three neighboring states. 5 years down the line, A Limited has become a strong brand, and therefore they plan to expand the business to the rest of the country. And this time again, the company opts for the public route to raise the funds by selling Mr. A's 20% of the stake. This is called as a non-dilutive FPO. In this type of FPO, the public shareholding gets increased. Generally, this type of FPO is used when more public participation is required, which will further grow the business and the share price of the company. Now, A Limited has been in existence for over 20 years and plans to expand globally. There are total 1 lakh shares of the company in existence trading at rupees 100. This time also, the company plans to raise the funds through the public offer but without selling anyone's stake. So, this type of an FPO is known as a dilutive FPO. In this case, after successful FPO, the share price will become rupees 50 as no one sold their stakes. You can see the stake will remain same in both the cases, pre-FPO and post-FPO. This type of FPOs can be used if a company is over leveraged and they decide to reduce its debt component by using the funds raised. Alright, so now you must be thinking that why, as an investor, we should go for an FPO. What are the benefits of an FPO from investor point of view? In case of IPO, when the company brings an IPO, it is comparatively very new in the market, and there is you need to depend on the red herring prospectus or the documents submitted by the company or the valuation submitted by the company for its future performance. However, in case of an FPO, lot of material or lot of data regarding the financial performance of the company is already available in the public domain. So whenever a company raises an FPO, an investor can always go back and check its past performance and based on that predict its future performance. So it is comparatively less risky than an IPO. Alright, so let's summarize our understanding. When a company raises funds from the public for the first time and then gets listed, it's called an IPO, initial public offer. And all the subsequent public offers are known as follow on public offer. So chronologically, FPO comes after an IPO. Then there are two main types of FPOs: dilutive FPO, wherein new shares are added, and non-dilutive FPO, in which the existing shares are sold publicly. The process to apply for FPO is similar to that of an IPO. That's it for today. Hope you have now better understanding of an FPO.